Hey there, traders. This is Christian from Tribeca Trade Group with your end of day recap for Wednesday, and a little bit of a roller coaster day today. You could see I've got the S&P 5 minute chart up, and basically back to where we started the day. Really weird day. We started we started the day. Futures were well bid into the open, with Europe rallying. Europe took off. I still really don't understand why Europe was so bid in the morning. They were up. The DAX and Euro stocks were up about 75 basis points. All basically through about 7 to 8 o'clock this morning, 7 to maybe 9 o'clock this morning. They rallied pretty hard from about flat, and then they kind of chilled out with our markets, and they ended up basically flat for the day. Their session was flat, but while Europe was rallying, and it gave our markets quite a bid pre-market, you could see. They got really heavy bid into the open. Nasdaq even more so. Nasdaq was up about 40 basis points going into the open, and then you see all those red candles, which often is the case. I always kind of take a conservative view on month end days because there's always somebody most likely bigger than you in the market that can really swing things around. And sometimes we see that right at the end of the month. We also see this on the first of the month. So be on the lookout for that tomorrow. Sometimes somebody just has a really big trade to do. And it could be one person, could be a bunch of people who've just have some. It also happens on index rebalances too, big quarterly index rebalances, to where there's either a big funding trade or there's to the upside or to the downside. So that's my thoughts for today. It looks like most of that selling pressure was done in the first hour or so of the day. Took a little while for markets to come back. What was interesting, and one of the first indicators that we saw in the trading room today was small caps. Small caps started to lead the market down, and really quickly. They were down over 1% today, I think around 1.3% today, and then climbed all the way back. So what are these? What do they look like right now? With this type of crazy hammer bar for today. Still, I think these could go IWM, small caps could go either way. It's really, let the price action tell you. And I see right now we're kind of just all over this 50-day, this purple line on my chart. Purple line is the 50-day, white line is the 200-day. We're all over this 50-day moving average. Listen, I'm not going to try to, predict which way they're going to go. I think if they, we're going to be in we're going to be in the June value area tomorrow because today's the end of the month. Not a bold statement there. What I would be watching for is basically 136.32. Let's see where we open tomorrow in IWM, but really that's going to be the picture. If we happen to open up below, maybe we've got some tough sledding for the month of June. If we manage to open up in value and kind of stay in value, then we'll just have to see. So that barrier on the upside is 139.12, and on the downside 136.32. I still think, while I really don't know which way small caps are going to go, I think those two levels are the ones to watch, and I think they're really important to pay attention to because they're showing more volatility right now than S&P or Nasdaq, and can also sometimes lead the market one way or another. So I think it's really good to keep an eye on what's going on here in IWM. Nasdaq. I was a little bit worried that we would see a reversal day, but you could see that there's no damage done here on Nasdaq or S&P. We're still above that yellow line on my charts, which is the 5-period exponential moving average. So a lot of volatility that really ended up being nothing. The VIX was up at one point, I think 5 or 6%, and then got squashed at the end of the day. So, if I had to root for one thing, I like when the VIX gets above 12 because I just feel like it's too euphoric when the VIX is around 9 or 10, but you can't always get exactly what you want. In terms of recovery, so while most of the indices recovered all the way back to flat, I didn't see a ton of stocks. Some stocks that got beat up kind of early. Like for instance, Apple. I didn't really see Apple recover too much today. That's way too zoomed in. Apple kind of stayed on the lows. Same thing with most of the FANG stocks. Many of them, like Netflix, kind of rallied up to rallied all the way. So they broke the value area, the green line. They rallied right back up to it, and we see that in a couple different places. But some names, some of the bigger names, a little bit of a head scratcher because I don't see all the big names really coming all the way back like the indices did. So when you break it down by sectors, there were certain sectors, a lot of the defensives. And I'll kind of show you a chart. Utilities did very well today. Keep in mind, bonds were up 30. While the VIX got smashed at the end of the day, bids held their own today. They're up 25 basis points, TLT. And GLD, which at one point was up 75 basis points right around midday, finished still up on the day, up 40 basis points. Couple things here as bonds continue to rally. One thing that I noticed, let's see if I have this chart. Yeah, I got this chart of TLT up. This is a multi-year chart. Couple observations here. This is dividend adjusted, so keep in mind on Bloomberg I've got dividends on here. But if I make this a little bit bigger, you don't need to see trade alert right now. If I make this a little bit bigger, one thing is this upward trend line here. It looks like we've kind of been on this thing here now for the last several months and kind of been grinding higher. So a couple observations. Number one, we held this trend line, multi-year trend line in TLT. Number two, it looks like we're trying to get above the I don't really want to mess up this chart if I zoom in, but you could see this yellow line. We just poked our head above the 200-day moving average here. So I think it's worthy. I was talking about structuring a TLT trade at the end of the day. I just didn't get it in. I was looking at some earnings plays, but I think it's worth trying to get long TLT. You can kind of see with the 200-day moving average, while we're above it, it is sloping down. Last time we did this, we held in here when the 200-day was sloping down, overtook it, and it looks kind of vaguely familiar here. So I like trying along above the 200-day moving average. I don't need to put these things on as soon as they get above the 200. If we get a little bit further above, gives me a little bit more bumper room than getting whipsawed and out of that move. Let's see if I can just bring this up here in TLT so you can see a 1-year chart. But yeah, just above that, just above the 200-day moving average, and you got some defined support. So if you're like me and has more equities than anything else, bonds right now would be a good diversification. So that kind of just brings me to the next subject. As bonds rally, yields go down. I think a lot of people are talking about the move into defensives. Have we been seeing this? Yeah, there's been a little bit of rotation out of tech. XLK had a decent outflow the last 2 days, and some utilities have seen an inflow. USMV, which is another ETF that is basically defense, has which I don't have that chart up anymore, but I can kind of show you. So a lot of people were really kind of wondering, hey, well, it's a warning sign that utilities and consumer staples are breaking out here 52 weeks high to a 52-week high. I don't necessarily. It's not that I disagree with that, but if you scale back and you look at a 5-year chart of XLU. It's basically been going up. It's just kind of paused. The trend has been up in utilities for the last 5 years. So the fact that they're breaking out, listen, they've been doing this for. Look at XLP. I mean, it's a pretty decent trend here. Is it getting a little bit extended? Yeah, maybe a little bit, but this is nothing new. The fact that consumers, I guess is what I'm trying to say, is it's nothing new that consumer staples and utilities are breaking out. They've been doing that this is a 5-year chart. This is USMV. This is minimum volatility. So basically all your defensive sectors, healthcare is in here as well. This has been the story for a long time. I mean, when things got really aggressive, they actually dipped down by the election time where, money went more into, some of the riskier sectors, but this is nothing new in terms of defensive rallyings and lower volatility names rallying, especially as we start to see bonds start to kick up here a little bit. So, the yield in this one, which again is part of the reason why people are going into this, is 2% right now. If you look at XLU DVD, The yield for utilities is 3%. So bonds go higher, yields go down. People start to move more into the defensives. A couple other areas that were interesting today, KIE, and we'll talk about the banks because I know that the banks are on everybody's mind. But KIE is the insurers ETF. Take a look at this thing. Really nice. Really nice move today above the 50-day moving average. This is the insurers ETF. For instance, we saw some calls a couple of weeks back, and HIG. This thing looks like it's trying to break out as well. So, the story with the banks, right? I think that has people freaked out a little bit. XLF was down pretty hard today and still looks troubled. Goldman is now right at may have closed below the 200-day moving average. There was a story out today about it was Moynihan from Bank of America said today, and I think J.P. Morgan also said the same thing, is that their trading revenues are down are down from last year. You know, the banks are just a different animal than what they used to be. It used to be that people said, hey, the banks really need to move up for the equities, for overall equities to rally. I disagree with this. Coming from and working at a bank for a long time, I could tell you that the game has changed. So you really have to look at this in terms of, not just is the economy, banks are not necessarily a benchmark for if the economy is doing well. I think a lot of people make that association. My experience coming from a bank is that it's a lot harder for these banks to make money. It's not necessarily because the economy is faltering that the banks are not doing well. It's because the margins are a lot harder. Listen, when I started, trading on the institutional side, hedge funds were making a lot of money and they were paying banks, they were paying the brokers a lot. The commissions per share used to be, there were some funds when I started trading, institutional trading right around 2005, 2006, there were some hedge funds that were paying 5 cents a share. Most of them paid 3 or 4 cents a share. Do you know what they're paying now? If you're lucky to get a penny a share on the institutional side, a lot of hedge funds don't pay commissions anymore. So it's a different game than it used to be. The fact that they got pretty cheap a few months ago, and there was some talk of regulations being rolled back, gave a nice rally from way back here where the banks were, and I can understand why they rallied. They did get very cheap, but it is not easy for them to make money. And then if you also look, besides not earning really much commissions, going back to Moynihan's statement about making less money on the trading side than they used to, it's also the case of interest. When interest rates are, when bonds rally and interest rates go down, it's harder for these banks to make money. So you have to look at it at not in a traditional way of what people associate with the banks and that they need to go up for the whole market to go up. I think you just have to understand that their business model has changed. People are also trading a lot. I mean, think about how much volume ETFs make up. They make up sometimes 20, 25%, sometimes even more of the average day's volume. They don't make a lot of hedge funds don't pay commission when they trade ETFs at all. So a lot of hedge funds also trade in the algos. They don't even use high touch brokers anymore. So again, my point is that it's banks are a lot different than they used to be. So the conclusion of this little rant here for a couple minutes is that I really don't want to own any of these banks. If they get really cheap again, yeah, sure, then it might be interesting. But especially when they're starting to look at, Goldman, which I consider one of the better ones, is breaking the 200-day moving average. Let's see if it holds here. But just for me, I'm staying out of it. I have no exposure right now to financials, nor do I want any. I have no exposure to energy, which also looks horrible. And I'm also not really trading the major indices. I'm trading individual names, and there's no reason for me to get involved in something that is breaking down and looks ugly. So that's just a quick thought on some of these groups that are breaking down a bit. You just don't have to trade them. You just don't have to be in these names. We can watch them go down. You can have a couple shorts on in these groups. You don't have to be necessarily. You could be like a hedge fund and kind of switch your model around and be a little bit long short rather than just long only. You have the flexibility as a retail investor to do that, where certain hedge funds are only long short or they're long only funds. Hey, you could do whatever you like here. That's the beauty of being a retail investor in this market. You could do anything you like. So that's the end of today's recap. Have a great night, and I will see you back in the trading room tomorrow morning, bright and early. Thanks very much.